Dan, the likes of Oxif and Bridgewater will not be getting investment from the Californian Public Employees Retirement System in the near future. Calpers has in fact said it's going to stop investing in hedge funds at all, and it is a $300 billion pile of assets. You've written on Alphaville quite a bit, making the case that institutional investors really shouldn't be investing in hedge funds. But my question is, why wouldn't Calpers just come back later on?
I really don't think they have to. They've had 12 years of attempting to invest in hedge funds. They've had 3 goes at trying to make their hedge fund investments work. And the thing to remember is their sister pension fund, the Californian Teachers Pension Fund, Calpers, has never invested in hedge funds. They just don't think it makes sense. And I think Calpers has come to that conclusion as well. There's no reason for them to come back.
Well, what was the obstacle to making their hedge fund investments work? I mean, what is the big problem for an institutional investor that, why can't hedge fund investments act as a hedge to their other asset allocations?
That's a wonderful sales pitch, isn't it? We just need some as a hedge. But what we increasingly find as academics look at this, as more attention is focused on what hedge funds are actually doing, I think we're coming to realise that hedge funds don't live up to the many various different sales pitches which there are out for them. They're supposed to dampen volatility, they're supposed to diversify, they're supposed to hedge. And the real problem is that if you're an institutional investor, what you're doing is exchanging one problem, what should I invest in, with another one, who should I pick to do those investments for me? And the problem with hedge funds is there is no way to pick them in advance. There are a few very good hedge fund managers out there, but you'll get a few very good hedge fund managers if you have thousands of different hedge funds. And pension funds simply can't pick those guys who are going to be good.
We are coming up against a very old Lex principle here, which is reversion to the mean, but we're also getting quite existential. I mean, given what you've said, why should anyone at all, let alone institutional investors, invest in hedge funds?
Well, that reversion to the mean is a very good point, because what you look for investing is the inherent source of a return. And if you treat hedge funds as an asset class, the inherent source of the return that you're supposedly looking for there is the intelligence of hedge fund managers. But here we have a problem. If you pit lots of intelligent hedge fund managers against each other, then surely they're going to compete away all these returns. So the inherent return from cleverness alone is going to be 0, and that's what you end up with. So we're not saying nobody should invest in hedge funds. If you're a private investor, we're not going to try and tell you how you should invest your money. And if you know 1 or 2 really good guys who run hedge funds and you want to give them money, then sure. But in terms of trying to build an institutional portfolio where you say we want to have a systematic allocation to hedge funds, I think once you've looked at all the evidence, not the sales pitch, you realise it just makes no sense.
Okay, that is some food for thought for hedge fund managers and anyone who gives money to them. Thank you, Dan.
Thank you, JC.